The Fed is handcuffed. At this point, they don't have a move to make. We're going to show you exactly why they can't cut rates and what is the one event that could change everything. And most importantly, we're going to show you why the symptom will also be the cure. We're going to take you through this step by step. Starting off, to understand this correctly, we must begin with today's economic reports, and they actually tell a very interesting story. Building permits tracks the permissions issued for residential construction projects. Measured in thousands, this month's building permits exceeded 1.5 million for the first time since August of last year. On a year-over-year basis, it's even more impressive. Increasing at an annual rate of 2.4%, this now marks the fourth consecutive month in positive territory. Why is this so important? Building permits acts as a solid leading indicator to the rest of the housing market. Every private house or housing development starts with a building permit. A permit issued today leads to a housing project tomorrow, but that is not all. Housing starts were also reported today. By the way, if you ever wondered what exactly is the difference between a building permit and a housing start, a building permit is the official authorization to begin construction, whereas a housing start represents the beginning of the actual construction project. Housing starts reported in thousands show a steady improvement in new construction projects started. Today's report now represents 3 out of the past 4 months exceeding 1.5 million. And on a year-over-year basis, an annual 5.9% growth signifies 4 consecutive months in positive territory. But let's put this all together. This is why this data is so important. The leading indicators are looking up. Building permits and housing starts are steadily improving. This shows us demand for new housing now exceeds supply, and that leads to higher prices. Well, rising prices is inflationary. In fact, we're going to see in just a moment, housing inflation represents the most significant part of our latest inflation report. And that is exactly why the Fed can't cut rates, because specifically of the inflation in the housing market. So, what does the Fed have to say about all this? This comes from Yahoo Finance. The Fed won't fix the housing market. Don't knock Yahoo Finance. They do have some pretty interesting insight. The U.S. housing market has a simple problem: affordability. But the issue is, the Fed's job does not include regulating housing prices. In a press conference this January, Fed Chairman Powell said, "We're not targeting housing inflation, the cost of housing, or any of those things. Those are very important things for people's lives, but they're not what we're targeting." The Fed rather seeks to fulfill its dual mandate of achieving maximum employment and stable prices, which it defines as inflation that averages 2%. The central bank struggles on this latter part of its mandate are why interest rates are so high and are expected to remain there this week. Now, here's the key. Moreover, housing costs and rent specifically remain the biggest factor in keeping inflation elevated. Home prices are at record highs, and the outlook on whether the supply needed to meet demand will make its way to the market is mixed at best. It's worth restating this last part. And the outlook on whether the supply needed to meet demand will make its way to the market is mixed at best. Well, we know better than that. Remember those building permits and housing starts that look so good? They're telling us supply will meet demand. But going back to the Fed's point, one of the key reasons why our inflation is just so sticky is because of those pesky high housing costs that just can't seem to come down. From our latest consumer price index report just the other day, housing is up 4.5% on a year-over-year basis and rent up 6% annually. So what is our outlook? How could this all play out? We now see the leading indicators such as building permits and housing starts are looking up, and this trend is persisting now for several months. This in turn leads to new construction projects. As these new homes and housing developments are built, despite the Fed's doubts, supply does in fact meet demand. Surging inventory leads to a decline in prices, and as a housing component represents the most inflationary of our very sticky inflation, when that begins to decline, the Fed is released from their restraints. Of course, there's more to this equation. Remember, the Fed has a dual mandate. They are charged with reducing inflation while maintaining maximum job growth. If our current environment of high interest rates begins to injure the jobs market and the overall economic growth, the Fed may be compelled to lower rates, which in turn could lead to a surge in inflation. We've laid out one of several paths our economy may choose to follow. We face a myriad of challenges: surging housing inflation, a sensitive employment market, precarious growth figures, and record high stock prices causing all of us to question their valuation. We're placing our hopes and faith in the leading indicators. Building permits and housing starts today lead to construction projects tomorrow and economic growth to follow after that. It's a daunting prospect to latch our hopes on the growth of one sector, but ours is a tale of optimism. Nothing great is achieved through pessimism or from the naysayers. Our housing permits and starts are rising for a reason. There's a lot of smart money at work, and they see reason for hope. Our economy's tale is one of the hero. We naturally gravitate towards the hero story. While it's a daunting thought to hinge our hopes that leading indicators in the housing market will lead to massive construction projects, which in turn will quash demand and grant the Fed permission to rein our interest rates back down. But just imagine if that happens just like that. A true economic hero story indeed.